I talk a lot about retirement planning on this channel, and one area that can't be neglected is how to properly structure an investment portfolio. As a federal employee, your TSP is likely your biggest asset, so you want to make sure you're doing the best job that you can to maximize it. There are multiple factors that you want to consider when creating your own portfolio, so let's jump right in. We've got a lot of really great graphics for you today, so make sure you save them either with taking pictures or screenshots as you see them. Just like the weather, there are also seasons in the economy. And a lot of pundits on TV really like to overcomplicate this. And I don't mean to minimize the complexity of economics because it can get complex, but there are really only 4 seasons, just like our weather, in the economy that you really need to be worried about. And we'll start here on the upper left-hand corner, which is a period of economic growth. This is when the markets are increasing, this is when companies are very profitable, and it's called an expansionary season in the markets. And eventually, inflation starts to become an issue, and just like we're seeing now, interest rates start to rise. This is the Federal Reserve attempting to start pumping the brakes. They make money a little bit more expensive, so in theory, it should make companies not as profitable and start to reduce their growth. This is known as a tightening period in our economy. Now, once this starts to begin, the theory is that we will eventually have a contraction. This is when the economy starts to decline. Earnings and profits from corporations begin to slow down. This is actually what we want because too much growth for too long isn't actually the most beneficial for our economy. Now, once the economy has sufficiently slowed down enough, we have a period in which we start to ease. And so interest rates may start to reduce again because now the government and the Federal Reserve are trying to re-stimulate the economy because maybe it's slowed down a little too much, and now they are trying to get more economic growth again. And this cycle goes round and round and round and kind of repeats itself. Sometimes it's very fast changing between the seasons. Sometimes it can be years between the different seasons. But this is really what you need to focus on because your investment portfolio is going to have to support your life and your retirement plan through all of these various different seasons. So just like we change our clothes, you may want to look at different strategies for your portfolio depending on what's going on. How many of you have made TSP investment changes based off of what some of your colleagues or friends were telling you to do? Or better yet, how about based on what you were hearing as economic news or what you were seeing the markets doing? How do they know your objectives and what's actually best for you? Have you done the modeling that determines whether or not that investment strategy is actually going to work out for you in the long run? You see, you want to create an investment allocation that is designed and surrounds your objectives. So let's say we run your plan and determine that you need to earn an annualized 6% return for the rest of your life. What investment allocation is going to help you do that this year? And what about next year? Or what about 5 or 10 years from now? What if something crazy happens, like the pandemic or something economic that completely is out of the blue that no one was expecting? How do you adjust in real time to something like that? When we look at creating portfolios, we want to be focusing on what are you trying to accomplish. So for example, let's say we have a client who maybe they're looking at a major purchase, like a home purchase, and they have to use a lot of cash for that. Or really, they're just trying to preserve their wealth because maybe they don't have a lot of time. Maybe this is an inheritance that they want to leave behind. Or perhaps they're retiring in a few years and they want to start becoming more defensive with parts of their money. Well, these goals are going to influence what kind of allocation is going to be appropriate for them. Now, let me just start off by saying this is a sample only, guys. Please do not use this as your own. You need to speak with your own advisors on this. Okay, so then we have another example where perhaps we've got some child education funding that's happening, but they are also still going for retirement, maybe not so soon, but they've got some future goals they're planning for. So perhaps we're looking at a balance between managing the risk, but also going for a little bit of long-term growth. Okay, this more moderate strategy is perhaps a little bit more in stocks, which is what equities are, and maybe a slightly reduced amount in bonds or fixed income. Perhaps some alternatives as well, like cash or money markets, cash alternatives, things like that. Other elements of a portfolio that will help them support these different objectives. And of course, the last example here is we have a federal employee who's maybe a little bit younger. Maybe they're 20 years away from retirement. Hey, if that's the case, you're not planning on using your money for a long time. Your objective here is really to grow your wealth as fast as possible. So you might be very heavy in stocks, something like the C fund. You may also have some in the F fund if you want to reduce some of that volatility. But for the most part, you're looking at stocks because that's what's going to give you that long-term accretion in value over something like 20 years. So you can see this is really how you should be thinking about your portfolio. What are you trying to accomplish? Look at investments simply as the tools that you need to be able to achieve your goals. If it's long-term growth, you're looking at stocks. If it's something more short-term, you're looking at maybe lower volatility stocks or perhaps some bonds, short-term money markets, things like that that will help you to meet your goals. Now for this one, you really want to make sure that you're doing the research on the investment selections that you're using in your portfolio. Now, while you're working and you are in the TSP, my general suggestion for people, and again, of course, check with your advisors on this, is that you stick with the 5 core TSP funds. I'm not really a huge fan of the mutual fund window as of yet, so the CSI, F, and G funds are really king from my perspective. However, as someone comes to retirement and are actually retired, their portfolio's job is not just grow anymore. Now it's starting to feed them, it's starting to create lifestyle for them. There's all kinds of new jobs that the portfolio has now taken on. It's looking to preserve wealth. It also has to grow for the future. It has to support a stream of income. And now all of a sudden, the other investment options in the universe of choices are, in most cases, actually needed for the success of their plan. But when there's so many choices, how do you go about doing the research? And here's a foundation that can help you get started. You really want to take a top-down approach when looking at your investment allocation. Obviously, when you have all of the choices available to you, like in the TSP mutual fund window, or if you are outside the TSP, same thing, you have hundreds, if not thousands of different options. Really, we consider just hundreds because out of the multiple thousands of managers out there, there are not more than several hundred that are actually worth using in our opinion. But regardless, that's still a lot of choices to sift through. So how do you go about doing that? Well, we start with a qualitative review on those managers. This involves looking at the interviews that the managers are participating in and what is the research that they are producing. What kind of roadshows are they doing that are talking about their strategies? We also want to look at the firm in general, its stability, the overall culture and alignment that it has with your objectives. We want to look at their team. What's the structure? What's their experience? What are the resources that they have at their disposal? The process. Are they in compliance? What's their track record? Are they in accordance to their own investment policy statement that they have for their funds? What is their tracking error to any index that they might be mirroring? So you start to apply these filters and you are really getting rid of a lot of managers that are really just not suited for your retirement plan. And then as you start to narrow the list down, you really get into a quantitative analysis that looks at the historical holdings. Are the holdings actually appropriate for your needs? Are they taking on more risk than you are comfortable with, or that your retirement plan can really sustain? We want to look at a factor analysis, forensic attribution, risk analysis, portfolio characteristics, all kinds of things that can be very helpful in determining really the short list of managers that are going to be the most appropriate for you, whether it's a Fidelity S&P 500 fund or a Schwab bond index fund. Whatever those different managers are that are going to help you to achieve your objectives. And that's the key. You want the ones that are aligned with your investment objectives, your cash flow needs, your tax minimization strategy, your growth strategy, all of the different things that you're trying to accomplish, not necessarily what the manager is trying to accomplish. So again, you want to be looking at these as a bunch of tools, like if you went to Home Depot for a project, and now you're selecting the right tools for the job. Now, why does all of this matter? Why not just stick to using Vanguard funds or Fidelity or BlackRock or whatever your favorite manager is? Well, because in retirement, your objective is reducing volatility. You guys all know that the TSPC fund is essentially the S&P 500, and that kind of volatility, if that's what you're invested in and that's the most conservative kind of stock investment you have in your portfolio, well, you're really subjecting yourself to a lot of ups and downs that could be problematic for you in the long run. So how can you achieve the growth that you need for the long term while also reducing some of that volatility? That's where having diversification of different managers is also helpful for a retirement plan. It allows you to have a whole lot less dependency on any one single manager. For example, BlackRock, which is actually one of the managers that does the TSP funds, BlackRock also does a lot of private funds known as the iShares. And they had a large cap growth manager that retired recently. Congrats, good for him. He deserved to retire after a long career. But who they backfilled with was not the same degree of experience, not the same degree of structure and process that they had. And that was concerning to a lot of investors because what they once knew that tool to be now was operating and behaving in a slightly different way. That's influential to your retirement plan because if you're invested in that strategy, how is that going to impact your retirement plan? These are things you need to be aware of. So using a multitude of different managers allows you to create further diversification and may actually allow you to reduce your overall risk by not having a total concentration in maybe 1, 2, or just 3 index fund managers. So now that we're talking about increasing diversification, what are the ways that we want to accomplish this? A very beneficial way that you can approach diversification is by making sure that your portfolio has multiple layers of diversification so that you are optimizing returns while minimizing that risk to your plan. People often compare the returns or the performance of different parts of the market like the S&P 500 without actually looking at the risk-adjusted rate of return. So sure, the S&P 500 or the TSPC fund performs really well in years that the markets are going up, but if you were to factor in the level of risk that is applied or taken by investing in that kind of strategy, what is the risk-adjusted level of return and rate of performance after the fact? Here's a format that we like to use when looking at portfolios with clients. Really, there are 5 levels of diversification that you want to consider for your own portfolio as well. And it starts with the first level of understanding what is the total asset allocation class. So for example, how much in stocks, bonds, cash, alternatives, what is that high level allocation that you should be considering for your plan? Next, you want to look at the sub asset classes. So within stocks, for example, some of them are large cap, others are small cap. We have growth, we have value. There's all kinds of different stocks, bonds, alternatives, cash, options that you want to be considering in your plan. Once you've got that down, you also want to look at the geographical diversification of your portfolio. We generally don't bet against America, but if 100% of your investments are US based, what if the US goes through an extended contraction period? What if there are issues that are only localized to America that are not for the rest of the world? For example, Japan is doing really well lately. If you're not participating in the global equities, you may be missing out. The next level we want to look at is also the individual managers. After going through levels 1 through 3, now we're looking at manager selection. Which Fidelity fund accomplishes the best large cap, US based, or maybe globally diversified fund? Is it Fidelity? Is it Vanguard? Is it Schwab? Is it BlackRock? There's tons and tons of managers out there. Some are better at doing certain things than others, and so you want to be doing the research on them as well. And lastly, as you're looking at these managers, looking at the individual securities that are selected by those managers. Are those securities aligned with what you actually want to be investing in? If you're looking at an S&P 500 index fund, are they doing the total S&P 500 index? Are they removing the most volatile S&P 500 index stocks, which actually perhaps could be beneficial for you? These are some things that you want to be looking at as you pick the choices for your portfolio. And really, again, this is just an example, but you can see that as you go through the different filters and the different levels, you're increasing the diversification, which over time is going to reduce that volatility for you and allow you to just smooth out your retirement ride so that you don't have to be worrying so much about what's going on in the markets. I've been saying this for the better part of a decade now, and tax planning is one of the most beneficial things an advisory firm could do for its clients. If you get amazing returns throughout the course of your retirement, but a third or sometimes even more of that goes to the IRS in the form of taxes, then what was your after-tax rate of return? How much did you actually earn if so much of it is going to taxes? If you take out the taxes altogether, what's your real rate of return? This is particularly true when you are retired because that's the first time that you really have control over how you generate your income in retirement. So you want to be doing a whole lot of tax management and doing tax planning along the way so that you can really keep more of what you earned throughout your life. That's really the name of the game here, okay? And so there are some strategies that you want to consider using in your own plan to accomplish this. If you have non-retirement accounts, tax loss harvesting is really, really great. You You want to make sure you're tax managing your total portfolio design, making sure you're taking withdrawals and rebalancing at the right time. This is a big one, guys. If you are subjecting yourself to sequence of returns risk, you might be causing yourself more taxes, more volatility, a lot of issues. Tax lock coordination, holding period management. If you are leaving a legacy or you're projected to leave a legacy for your heirs, are you doing that in the most tax efficient way? A lot of different ways that we want to be doing this to determine what is the tax implication and how do we actually minimize taxes for you along the way. This is a big thing that you want to incorporate in your plan as well. So if you learned anything new today, let us know by hitting the thumbs up on the video, maybe sharing this with one of your colleagues. Guys, our objective is to grow this channel, but the only way we can do that is if you're sharing this with the people that you know and you love and you care about. So I hope this was helpful, and until next time, stay wise and stay wealthy.